Welcome you back to Business Morning this the Wednesday, the 20th of December. Let's dive into the mutual funds market. And oftentimes we talk about stocks and bonds and what have you. Mutual funds basically is a portfolio put together by some folks who call themselves fund managers or whatever, asset managers, like Ola Belgore, for example, and they put some stocks and whatever, try to select that and try to help you play the market so that you don't get bonds. That means they're the professionals. So they're the one taking the heat off you, but it comes at a cost. It's not free. So, but they give you some returns as well. Nothing comes free. Let's bring Belgore into the conversation. As the Managing Director and Chief Executive Officer at Afrinvest Asset Management. Good morning.
Good morning.
It's good to have you here. It's been a very, we can have a handshake to the market.
Yes.
It's been a very nice year. You folks made money. So
our clients made money.
Your clients made money.
Yeah.
When your clients made money, you make money.
We're happy for our clients.
We're happy. You're happy for your clients.
Yeah.
Happy is the one who delivers happy clients. That's what it means. That's what it's all about. That's why you are in the business of managed funds. So you're managing people's portfolio.
Yeah.
So the strong equities market in 2017 and the fixed income, you think is played, and very good currency market as well, have played into mutual funds. Yes or no?
Yeah, definitely. Thank you for having me again. Like you said, 2017 has been a very good year for investment in Nigeria. Practically all the managed funds recorded very good returns, well above inflation rate. So you got real return on investments in 2017 from fixed income bonds, funds, to money market funds, equities. Almost everything is
above interest rate, also above inflation.
Also above inflation, yes.
What a nice year! What a very nice year. I wish I'm part of that. You folks make close to 20%, right? In terms of real return, 20%? Is it safe to say?
Yeah, for the equities portfolio, if you look at all the equity mutual funds in the Nigerian capital market, I don't think anyone has done less than 30% return in 2017. We are, at Afrinvest, we have an equity fund that is called the Afrinvest Equity Fund. We're at about 41% return year to date.
And what's the size of that?
It's about 500 million portfolio. Portfolio.
Interesting. But if you look at, I want to let's go straight into the new year. Our foreign exchange market was good news for you, fund managers this year. Do you think it will remain a very an icing on the cake for you in 2018?
We hope so. 2017 didn't start as great. You remember that market was a bit depressed until about the end of first quarter when the I&E window came on board, and it's been because of the semi-easing of the foreign exchange policy. It's been very good for the market. So we think that the trend will continue. Coupled with the fact that oil prices is going up, production for us is still is good. We're above the 2.2 million barrel per day and all of that. So we think that it will be a good year, 2018.
How easy, or how do you build a portfolio, for example? And how do you, once you want to build it, how do you select your assets? What are the key considerations for a fund manager?
Okay, it may be necessary for me to explain what a managed fund is. It basically is pulling funds of different investors together into a fund that is then put in a portfolio to meet the expectation of that category of investors. So you could have the young and aggressive investors who may want to go into equity funds. You may have the risk conservative investors who may just want money market returns and all of that. So it depends on what your clients are looking at. But the beauty of managed fund, which you may also call mutual funds, is that it reduces the individual risk. You know, because by pulling so many people together, their funds together, you can then diversify across the instrument in whatever asset class you have chosen. So the So you have equity fund, you have money market, you have fixed income. You sometimes have balanced funds, which is a mixture of equities and money market. There are also some specialized managed funds like infrastructure and all of that. So whichever one you go to will depend on the asset you choose under each of those categories will depend on what your aspirations, what your target is for the fund.
Who is in the market at the moment? Who wants managed funds? Is it the big guys, the usual elite? Is it the middle class, like yourself, who has a lot of money to put aside? Or the young guys who are in the telecom, whatever industry, who are into all of that, and they feel that, look, I just need to buy something very quickly because I want to get in on the game?
Well, interestingly, unlike in the past, almost every category of investors is in the market now. You have the high net worth individuals who you would give customized services to, of course. But you see a lot of us, fund managers, a lot of us are targeting the retail client. Before now, for some funds, you have minimum entry being about 50,000 naira or 100,000 or more. But right now, we're going as retail as 5,000. We've just launched a money market fund, the Afrinvest Bluetooth fund, and the minimum you need to subscribe is 5,000 naira. So you're making it more affordable because the people out there want to invest to secure their tomorrow.
5,000 naira, Nigeria Savings Bond, which the debt office also has on the street, is 5,000 naira. So I keep asking the question. When folks says Nigerians don't have money, if I may use that balance, which is basically a street expression, Nigerians don't have money. But now you're bringing a mutual funds from 100,000, 50,000 down to 5,000 naira subscription, and folks are still buying. And they're interested, aren't they?
Yeah, of course they're interested.
So it means there is money.
Well, it's relative, but of course, no matter what situation, I mean, we try to, as a community, the investment, the capital market operators, we try to do financial literacy and encourage people to put aside something from whatever they have today. Because you think today is tough, you don't know about tomorrow. So you have to save for the rainy day, as they will say. You have to put aside something from whatever you earn today. The rule of thumb will be that for every income that comes your way, you put about 10% on investment or savings or something, you know, so that when tomorrow comes with these unexpected, expectations and all of that, you're able to meet your basic needs and all of that. So it's not that I don't know if there's so much money.
So if I do 10% tithe, I can do 5% mutual funds.
Oh, well, it's your, it's your choice.
My prerogative. That's my prerogative.
Yeah,
if I put 10% as tight, I should be able to do 5%. Again, if you look at 2016, 2017, well, 2017, we tried to claw our way out of recession, but were investors interested in managed funds in 2016? Let's just step back into that.
Yeah, things were a bit rough in 2016, and remember the capital market return, the Nigerian Stock Exchange, the Osher Index returned negative. Of course, that was a disincentive to investing, and so when the market is positive, of course, people have reasons to take a little more and, you know, invest more because they get good return. So 2016 was not as fantastic as the current year.
Where is investors' confidence coming from in terms of the fundamentals?
I think that the economy is a bit stable. We're out of recession. In 2016, we were in recession. We're moving far away from that. It looks like the government, some of the various government policies are beginning to sink in, and they're taking foothold, and the economy is gradually improving. And, of course, you have to believe in a better tomorrow, too. So I think those are all the attributes. And like I said, returns also. If you're laid back and you've seen your friend has made about 40% return on his equity investment, of course, there's a high chance that you would also want to start doing something about that. And, of course, the treasury, the money market environment was quite very good. Almost everybody now knows there's something called treasury bills. It used to be for the upper class and all of that. But because Treasury, the yields were fantastic. You had up to about 17, 18% yield and all of that. Of course, it was a no-brainer that people will want to take advantage because it's secured. You know, it's the safest form of investment, and then you're getting that kind of return. It just attracted people to the market.
What are the key challenges for fund managers when the market is rough and when the market is sweet?
Well, when market is rough, that's when the test or, I mean, your capability is brought to fore. There's this argument about who a good asset manager is. You know, to the client, a good asset manager is one that gives positive return. But in real sense, when you look at it, it's about comparing yourself against the established benchmark. So if I have an equity fund, for instance, and I'm tracking the all-share index, as a fund manager, am I able to outperform the all-share index? So say, for instance, the all-share index did a negative 10%, and I do negative 2%. Then I'm a good fund manager because I outperformed that index, you know. But then the client out there doesn't care because you have given him a negative return. So that can be a challenge. So you have to think about your strategy. You know, sometimes you go for passive portfolio. You buy good stock, good asset, and then you leave it and monitor it. But then when market changes, when times are rough, you have to be a bit aggressive and change that strategy so you can give good return to your client. But of course, when markets are smooth, everybody smiles to the bank.
Everybody market is smooth. Everybody is smart.
Yeah, everybody is smart, exactly.
When the market is smooth.
When the market is smooth.
So the time when you know a very smart and good fund manager is when the market is rough.
Yeah, definitely. Yeah.
Okay, so it's no brainer. But let's look at what the federal government is doing. We've seen Buhari's administration coming up as with a portfolio of its own bonds. I don't know if you folks are thinking that this is a time to build something around this, the emergence of specialized, dedicated bonds, from diaspora bond, perhaps mining bond, you have the green bond, you have the sukuk, you have the infrastructure. Is this something we should think about moving forward, maybe in 2018?
Yeah, it's something a lot of us in the fund management space are looking at. You remember, let me take you back to what we do at Afrinvest. You remember that in 1997, thereabout 1999, when we had the Nigeria borrowing exposures and all of that, we created a fund that is called the NIDF. It's been 20 years now. That was to track the Nigerian borrowings at the time and all of that. Of course, it's been restructured to modern reality. So now this is, again, another opportunity for fund managers out there. There's the diaspora bond, there's sukuk, there's savings bond, there are all sorts of opportunities. The client there are looking for innovations. They're looking for freshness. They're looking for new things and all of that. So it's our responsibility to look at what is available in our market. Before now, we probably complained that there wasn't enough opportunity to choose from. But now government is leading the forward. They're bringing new things. Green bond is coming. There may be infrastructure bonds and all of that. So it's just broadening the investment space.
Do you think that will be a good one if you're giving me an outlook in the new year?
Yeah, definitely. It would be a good one. We think that, like I said earlier, we think 2018 will be a good year. Earnings, we think, will still drive the equities. So if you have equity bonds, equity funds, rather, they should do well. Maybe not as well as 2017 because you're using a base here of 40% return, you know, but we think it should do well. The only one that may not do as well is treasury bills, you know. We think it's going to be probably single digit.
Moving forward.
Moving forward.
So with those restructuring that the government wants to do.
Yeah, because government is not looking for external...
Ola, you've got to hang around a little bit. We need to take a break. We're going to expand this conversation a little bit into the exchange-traded funds market in the new year. That's also something close to what we're talking about here. And Michael Famaroti is joining us from Vertiva to continue this conversation about the markets in 2018. We'll be right back in 2.